If you have more than 3 accounting tools but still can't find the numbers you need, your tech stack isn't saving you time, it's stealing it. Look, I see this all the time. You invested in QuickBooks, Bill.com, maybe Ramp for your corporate card, Gusto for payroll, and a CRM. Probably some project management software as well, all really solid tools. But it still takes your team 3 weeks to close the books. You're still manually downloading CSVs and copying data between systems, and getting a P&L is like pulling teeth. And I'm here to tell you that it's not the tools. It's that nobody designed them to work together. Today, I'm going to walk you through the 3 ways your finance tech stack is probably working against you right now, and what a properly integrated system actually looks like. This is the type of stuff we fix for clients every month. If this type of a breakdown is helpful, subscribe. Next week, we're getting into entity structures and the tax implications that most CPAs don't mention. But real quick, let me show you why this even matters. You know how this goes. You're at a conference or talking to another founder, and they mention this amazing tool that solved their invoicing problem or whatever. And you think, oh, that would help. So you sign up. 6 months later, different conference, different tool, sign up again. Before you know it, you're paying for 8 subscriptions and your accounting is somehow slower than when you started. And there's actually data on this. Businesses with 5 or more disconnected financial tools spend about 14 extra hours every month reconciling data between their systems. That's almost 2 full days of just moving numbers around. A tool sprawl is sneaky because each decision makes sense in isolation. Your CRM tracks deals, your project software tracks delivery, your payment processor collects money, QuickBooks tries to track everything, but they're not talking to each other. So you know what happens? A customer pays an invoice through Stripe. Stripe knows, but your CRM doesn't, QuickBooks doesn't, your project manager is still sending payment reminders, and you're updating different systems for one transaction. You didn't buy these tools to create busy work, but that's what happened. And it's not just annoying. If your team is spending 15 hours a month playing telephone between systems, at $50 an hour, that's $9,000 in labor, just doing spreadsheet work. But there's a better way to do this, so stick with me. You might be thinking, wait, but I did connect my tools. I set up Zapier. Yeah, I know, but connection is not the same as integration, and this is really important. A true integration that's built for success means a process is mapped out and the softwares are talking to each other in a way that helps you achieve your goal. This means that data is flowing in both directions automatically with proper mapping to your chart of accounts. But what do most businesses have? A handful of one-way zaps that break every month and nobody notices until April. We had a client last year doing about $8 million in revenue using Bill.com connected to QuickBooks. Sounds great, right? Except the implementation wasn't done with any thought, so the liabilities were mapped to the wrong account on the balance sheet and the expenses only had a couple options, none of which were appropriate as the company grew. This means they were only using a few accounts for all their transactions and needed to re-reconcile at the end of every month to break it out. Their P&L was completely useless, and they couldn't tell the difference between cost of goods sold and operating expenses. Every single month, someone had to spend hours recategorizing those expense transactions to the different accounts. That's not automation, that's automating more work. When we redesigned their system, we mapped every vendor in Bill.com to the correct expense category in QuickBooks. We set up approval workflows that trigger the right accounting rules. And now, when they approve an invoice, it automatically hits the right account, the right class, the right project. Nobody has to touch his settings again unless there's a material change in their business. That's the difference between tools that are connected and a system that's actually integrated. And honestly, most businesses have an even bigger problem with their data flow. This probably sounds backwards, but badly implemented automation is often worse than just doing it manually. I know, but think about it. When you do something manually, you know it needs attention and you budget time for it. You have a process. But when you automate something badly, you assume that it's handled. Then 3 months later, you find out your inventory counts have been wrong the whole time. We see this constantly with corporate cards. Business owner gets Ramp and connects it to QuickBooks and thinks they're done. But nobody set up the approval workflow, nobody mapped the expense categories properly, and nobody created rules for what's allowed. So now you've got transactions flowing in with no oversight, personal expenses mixed with business, everything landing in miscellaneous. And your bookkeeper spends 10 hours a month fixing it. The work didn't go away, it just moved somewhere less visible. So before you automate anything, design the workflow first. What data needs to flow where? Who approves what? What happens when something doesn't fit the rules? That's what we mean by systems implementation. Design first, then automate. And this is one that drives me crazy. You have all this data sitting in your tools, but you still can't make decisions with it. Sales data in your CRM, expenses scattered across 3 systems, payroll in Gusto, project profitability in your project management tool. To see your actual margins, you have to export 5 reports and build a spreadsheet. By the time you finish that, the data is 2 weeks old and you've already missed the decision window. Businesses that can see real-time financial dashboards make strategic decisions more than 3 times faster than those waiting for month-end reports. That's a real competitive advantage. What does a well-designed system look like? Every tool should feed into your central source of truth, usually QuickBooks Online or Sage Intacct if you're bigger. From there, you build one dashboard that pulls live data. The framework we use with clients is pretty straightforward. Number 1, do an assessment. What tools do you actually need? Most businesses can probably cut around 30% of their subscriptions without even blinking an eye. Number 2 is a design. How should the data flow between your systems? Next, number 3 is integrate. Set up bi-directional, rule-based connections. And then number 4 is automate. Build workflows that match how your business actually works. Lastly is reporting. Create one central reporting hub, whether it's a dashboard or a monthly financial reporting cadence. Let me give you an example of what this looks like. $12 million manufacturing business running on 9 different tools. Month-end close took them 18 days and their CFO was completely underwater. By doing analysis, they were able to consolidate into 5 tools that were properly integrated. They used Sage Intacct as the core, Bill.com for AP automation, and their payment processors feeding directly into the ERP. Gusto for payroll with full GL mapping, and one dashboard pulling everything all together. After 90 days, month-end close went from 18 days to less than 5. Manual data entry dropped from 40 hours a month to 4, and they eliminated 4 tools. Software costs actually went down by a couple $100 a month. But this is the real win. Their CFO can now see margin by product line in real time. They killed 2 unprofitable products and doubled down on 3 winners. In the first quarter after implementation, their EBITDA increased just by having this visibility that allowed them to make quick decisions. That's what happens when your tech works with you instead of against you. All right, so a quick recap. Tool sprawl is probably costing you 14 hours or more a month. Bad integrations force manual cleanup, and poor automation is worse than no automation. And a properly designed system pays for itself in eliminated labor and software costs in probably less than 2 months. So do this next. Perform an assessment of your tech stack and ask 3 questions. Do I have tools that do the same thing? Are my integrations actually bi-directional and rule-based? And can I see my key metrics in real time without exporting anything? If you said no to any of those, you probably need to redesign your system. If you want to chat through how your tech stack is working and some potential improvements, leave a comment below or reach out to us on our website, proseer.co, and we'll schedule a time to chat. If this was helpful, please like and subscribe. We break down one video like this every week that helps you get more profitable in less time. See you in the next one.